It's funny. When we think about the future of technology, we almost always picture, like, the brain.
Right, the software side of things.
Yeah, exactly. The software, the algorithms,
Mm.
the absolute magic of artificial intelligence answering our questions and, solving complex problems. But we rarely picture the stomach.
The stomach. I like that.
Right. We rarely think about what this massive digital brain actually has to eat to survive.
Which is, in a word, electricity.
Yeah.
Just staggering, incomprehensible amounts of electricity.
Rarely picture the stomach, but today, for this deep dive, we are looking at Cipher Digital, or CIFR for short. This is a company whose entire business model is basically feeding that insatiable appetite of AI.
Yeah, that's their whole game right now.
So we are diving into a stack of financial analyses, market data, news flow, all to figure out if Cipher is like the ultimate proxy for this massive structural shift happening in the tech world right now.
Because the defining constraint of the current tech era is no longer just silicon.
Right.
The bottleneck is raw power and, well, ready-to-use infrastructure. Because you can buy all the advanced computer chips in the world, right?
Yeah.
But if you don't have a plugged-in, cooling-equipped, gigawatt-scale facility to house them in, those chips are just, they're very expensive paperweight.
Just sitting in a box somewhere.
Exactly. And that is the exact void Cipher is attempting to fill. They are transitioning from their legacy foundation, which was Bitcoin mining, into the booming world of artificial intelligence and high-performance computing.
Okay, so to really understand where Cipher's going with this high-performance computing pivot, we have to look at the bizarre reality of their current balance sheet.
Oh, it's definitely bizarre.
It really is. Looking through the annual and quarterly financial reports in our data stack, it feels like you're looking at two completely different companies at the exact same time.
Yeah, the split personality of their financials.
Exactly. So, okay, let's unpack this. The top-line success is robust. Their trailing 12-month revenue growth is up 37.96% year over year.
Which is huge. It proves accelerating demand.
Right, and their gross margin is sitting at 59.95%. Keeping nearly 60 cents on the dollar after direct costs is, that's a fantastic unit economy for any business.
It really is. Those gross margins tell us that the core day-to-day operation of running compute cycles is inherently highly profitable.
Yeah.
The actual mechanics of taking power from the grid and turning it into digital output, it just works beautifully on a unit basis.
But this is a massive but.
Here it comes.
You scroll down the page and you hit a brick wall.
Yep.
The net margin, the actual bottom line after everything is accounted for, is negative 427.79%.
It's quite a number.
And the earnings per share is negative $2.26. Okay, wait, how is this not a massive, glaring red flag for any investor looking at this business?
It sounds terrifying.
Yeah.
Right.
How do you lose 4 times what you make and still keep the lights on? Literally.
Right. When you see a negative 400% net margin, your instinct is usually to just run in the other direction fast. But digging into the financial filings reveals this isn't a story of operational failure. They aren't burning cash because their core business is broken.
Yeah.
That massive negative number is driven almost entirely by non-cash depreciation, expansion-related impairments, and just incredibly aggressive reinvestment.
Wait, break that non-cash depreciation down a bit for me, because that sounds like accounting magic.
A little bit, yeah.
So they aren't actually writing checks for that negative 427% right now.
Exactly.
Yeah,
They aren't.
all right.
So the accounting rules require you to write down the value of massive physical assets over time.
Right.
When you build a sprawling data center, fill it with servers, install advanced infrastructure, the depreciating value of those assets shows up as a massive expense on the income statement.
Ah, I see.
It drags the net margin deep into the red, but it doesn't actually cost them any cash out of pocket in the current quarter.
Got it. So the cash they are actually generating, their free cash flow, is just bypassing the bottom line and being poured directly into procuring more power and land.
Yeah, they are essentially sacrificing the present to own the future.
Wow.
Instead of sitting on a pile of cash to make the balance sheet look pretty for a quarter, they are buying more concrete, more wiring, more specialized equipment.
It's constantly building.
Right. And forward guidance from the analysts suggests the market is pricing in a turnaround specifically because of this strategy.
Because it's working.
Right. The expectation is that once these new AI hosting capacities actually come online, all those high gross margins we talked about.
I think 2%.
Exactly. They will finally cascade down to the actual bottom line.
Okay, that makes a lot more sense. That shifts the conversation from why are they losing money, to what exactly are they building?
Exactly.
Because if they are reinvesting at that aggressive of a clip, it has to be something highly differentiated. Which brings up a technical question for me.
Sure.
Why is this pivot so expensive? If they already have data centers for Bitcoin mining, can't they just, I don't know, swap out the computers and call it an AI facility?
Oh man, if only it were that easy.
Not that simple, huh?
Not at all. The physical differences between a crypto mine and a high-performance computing center are vast.
Really?
Yeah, I mean, a legacy Bitcoin mining facility is relatively crude. It is often just a massive warehouse, heavily ventilated, using basic industrial fans to blow ambient air across racks of ASIC machines.
Okay.
It requires power and a basic internet connection, but that's kind of it.
So it's essentially just a noisy shed with a lot of electricity flowing into it.
Very much so. Yeah, a noisy shed is a good way to put it. But an AI data center is a completely different beast.
How so?
Well, AI clusters run incredibly hot. They require liquid cooling directly to the chips.
Oh, wow.
Yeah, and the floors have to be massively reinforced to handle the sheer weight of these dense server racks. Plus, you need highly redundant backup power systems.
Because if it goes down,
Exactly. An AI training run cannot afford to lose a single millisecond of power, or the entire process might have to restart, which costs millions.
that's insane.
And most importantly, you need high-speed, high-bandwidth fiber optic networks to connect all these GPUs together so they can talk to each other instantaneously.
Okay, so they aren't just changing the furniture. They are fundamentally rebuilding the house from the studs up to support a much heavier, much more delicate operation.
That's spot on. Upgrading from air-cooled crypto sheds to liquid-cooled fiber optic AI fortresses requires immense capital expenditure.
Right.
And that is the reality behind those massive impairment charges on their balance sheet. They are tearing down the old to build the new.
So if they're successfully building these AI fortresses, that localized monopoly on power becomes their true competitive moat.
It's a massive moat.
The macro data here is just staggering. Like, we have recent comments from Alphabet CFO confirming that AI demand still vastly outpaces global capacity.
Vastly.
And we also have this incredible detail from the sources about AMD partnering with Anthropic to deploy up to 2 gigawatts of GPUs. 2 gigawatts.
It's hard to even picture that much power. You have these massive players hoarding silicon. The hyperscalers companies like Amazon Web Services, Google Cloud, Microsoft Azure, they are buying up GPUs faster than the physical world can accommodate them.
Right. It's like everyone just bought state-of-the-art, shiny new ducats. But Cipher Digital is the one sitting on the only water well in the desert.
I love that analogy. And securing that water well takes years.
It's not overnight.
No, you have to negotiate power purchase agreements with local grid operators, secure the physical land, pass environmental studies, and then actually build the specialized cooling infrastructure.
So there are real barriers to entry.
Huge barriers. You cannot spin up a gigawatt data center overnight, no matter how much money you have.
Speaking of money, the market cap for Cipher is sitting around $10 billion.
Right.
That gives them some equity scale, but building out multiple gigawatt-scale campuses requires billions in upfront capital.
It does.
The sources point to a competitor, Hut 8, which recently priced $3.25 billion in fully amortizing senior secured notes just for a 245-megawatt campus.
Yeah, that was a huge deal.
And the implication is that the capital markets are wide open. But wait, Hut 8 is a completely different company.
True.
Just because one competitor managed to raise billions in debt doesn't mean Cipher can seamlessly do the exact same thing, right? Especially when we just discussed their negative 400% net margin.
Right. You'd think lenders would run away.
Yeah. Are we sure lenders won't blink at those numbers?
It is a vital distinction to make, for sure. But debt markets in this specific sector don't look backward at GAAP net margins.
Oh, they don't?
No, they look forward at the underlying contracts. Lenders are willing to fund these massive projects because the infrastructure providers are signing take-or-pay contracts with the hyperscalers.
Take or pay, meaning the hyperscaler agrees to pay for the power capacity whether they actually use it or not.
Exactly. The risk is entirely removed from the infrastructure provider.
Oh, wow.
If a massive tech company signs a 10-year take-or-pay contract for 100 megawatts, a bank can look at that contract and easily underwrite the debt to build the facility.
Because the revenue is guaranteed by, like, a $1 trillion counterparty.
You got it. The fact that Hut 8 secured $3.25 billion for a fraction of a gigawatt proves the debt markets are hungrily underwriting these exact types of contracts.
So Cipher is next in line.
Cipher, with a larger footprint, is in a prime position to leverage that same debt mechanism without diluting their equity to zero.
Okay, that makes sense. But there is another layer to their moat that feels uniquely powerful to me.
What's that?
Because they still have their legacy Bitcoin mining operation, they can co-locate their crypto mining with their AI hosting.
Yes, this is a game changer. This creates a dynamic flexibility that pure-play data centers simply do not have.
How so?
Think of Cipher not just as a landlord, but as a sophisticated rail yard operator.
Okay, a rail yard operator.
They own the tracks, which in this case is the massive power grid interconnect. They don't necessarily care what kind of freight is running on the tracks, whether it's Bitcoin ASICs or AI GPUs. They just want to route the power to whichever train is paying the highest freight rate at that exact millisecond.
Oh, that's brilliant. So if the price of Bitcoin spikes, they pull the lever and route maximum power to the mining rigs.
Exactly.
But if an AI hyperscaler urgently needs back-end compute for a new model, they switch the tracks and route the power to the liquid-cooled racks.
Right. They are completely insulated from being caught on the wrong side of the demand curve.
They win either way.
Pretty much. It maximizes their revenue per megawatt and ensures they are never sitting on stranded, unmonetized power.
Well, if they have this localized monopoly on power and the ultimate flexibility to monetize it, Wall Street must be pricing that in.
Oh, they are.
Looking at the price action and the data we have, it is staggering. Cipher is trading around $24.46, up almost 7% on the day we pulled this data.
Yeah.
But the zoomed out view is the real story. They boast a 55% year-to-date return and a massive 266.24% return over the last 52 weeks.
Those are monster numbers.
I know. The stock ran from a low of $4.55 all the way to a high of $30.14.
The technical setup shows the stock is consolidating just about 18.8% below that 52-week high. It is forming a higher base pattern, suggesting the stock is kind of digesting that massive run-up and gathering energy.
Just taking a breath.
Yeah, exactly. The momentum is heavily driven by the broader sector rotation into AI infrastructure. Investors who missed out on the initial NVIDIA hardware boom, they are now looking for the secondary derivative plays.
And the analyst targets are certainly reflecting that rotation. Like Morgan Stanley is maintaining an overweight rating on Cipher Digital, setting a price target of $47.
Yay.
Doing the rough math, that implies nearly 90% upside from its current trading levels.
It's massive.
And there is also a significant amount of chatter regarding potential gigawatt-scale partnerships with major cloud providers.
Yeah, and while those specific hyperscaler partnerships aren't confirmed for Cipher yet, the broader market is clearly pricing in a high probability of those deals happening.
Right, the demand is just too high.
The hyperscalers are desperate for capacity, and the infrastructure providers hold all the leverage in negotiations right now. Wall Street is anticipating those take-or-pay contracts being announced in the near term.
But hold on, I was reading through the insider flow data, and it initially paints a completely contradictory picture to all of this.
The insider trading data. Let's hear it.
Over the last 90 days, company insiders made 43 sell transactions compared to only 24 buy transactions.
Okay.
The people inside the company are selling almost twice as often as they're buying. If this rail yard operator model is so bulletproof and Morgan Stanley sees 90% upside, why are the insiders cashing out?
What's fascinating here is the nuance between transaction frequency and transaction volume.
Frequency versus volume.
Yeah, you are looking at the number of individual trades, which heavily skews towards selling. But when you look at the sheer amount of shares exchanging hands, the narrative flips entirely.
Really?
Yes. Despite those 43 individual sells, the net volume over those 90 days resulted in an accumulation of 9,745,205 shares bought by insiders.
Wow.
Hey.
Nearly 10 million net shares accumulated.
Exactly.
That is a massive discrepancy between how often they trade and how much they actually buy.
Right, because executive selling is often a frequent scheduled event. They sell small batches for tax purposes, exercising options, or just basic portfolio diversification.
Just automated stuff.
Yeah, it generates a lot of small automated transactions. But when insiders buy, especially accumulating nearly 10 million shares, they're doing it in massive concentrated blocks.
Which means what?
This volume heavily indicates that the people who know the underlying fundamentals best view the current price levels as a deeply discounted entry point before the next leg of AI infrastructure contracts become public knowledge.
Ah, so they see the writing on the wall.
Yes, they do.
The volume tells the real story, not the frequency. That makes perfect sense. But as much as the upside potential is alluring, a 266% return in a single year usually comes with a fair amount of gravity attached to it.
That's the reality of the market.
We need a sobering look at the risks, because nothing goes up in a straight line forever.
Absolutely. The valuation metrics reflect that gravity in very stark terms.
Yeah, the sources highlight that Cipher's beta is 3.22.
Hmm.
And beta measures how volatile a stock is compared to the overall market, right?
Correct.
So if the S&P 500 moves 1%, a stock with a beta of 1 moves 1%. A beta of 3.22 means Cipher is hypersensitive.
Extremely sensitive.
It'll amplify market rallies, but it will also sell off violently on red days.
Right.
And then you look at the price-to-sales ratio. It is trading at an astronomical 47.68 times sales.
Yeah, at almost 48 times sales, coupled with that negative earnings per share we discussed earlier, the stock is basically priced for perfection.
Priced for perfection. What does that mean mechanically for the stock price if they, hit a speed bump?
It means the market has already given them full credit for the AI transition working out flawlessly.
Oh, I see.
The current share price assumes they will flawlessly convert their gigawatts of power capacity into highly profitable HPC hosting without any construction delays, without any contract disputes.
No hiccups at all.
None. If Cipher fails to secure those rumored long-term hyperscaler contracts, or if supply chain issues delay their liquid cooling installations, they face severe multiple compression.
Multiple compression.
Yeah.
So that's the market suddenly deciding they aren't willing to pay 48 times sales anymore, dragging the stock price down even if the core business is still technically growing.
Exactly. The premium just evaporates.
Yikes.
The market will mercilessly reprice the stock to a lower multiple if the execution of this pivot isn't completely flawless.
There is also a significant macro catalyst risk tying back to their legacy crypto business that we really need to factor in here.
We do, yeah.
The sources mention the Clarity Act and recent macro news regarding crypto regulatory guardrails. Now, putting politics aside entirely, the Clarity Act matters to Wall Street for one specific reason: baseline revenue.
Right. The regulatory environment acts as a massive lever on Cipher's current cash flow.
Yeah.
The Clarity Act represents a potential framework for standardizing how crypto assets are treated institutionally. When news of legislative progress hits the wire, it acts as a macro headwind clearing. It unlocks institutional capital and boosts Cipher stock alongside the broader crypto market.
But the risk is the inverse, right? If legislative momentum stalls out and we return to regulatory gridlock, the crypto mining side of Cipher's business could face renewed headwinds.
Exactly. And that baseline crypto revenue is the engine funding their massive AI data center expansion.
Right, they need the cash flow.
Building those fiber optic, liquid-cooled fortresses requires constant cash burn. If regulatory pressure suppresses Bitcoin prices or mining profitability, their cash flow dries up.
And the build-out stops.
The AI expansion slows down, and that priced-for-perfection valuation gets immediately tested.
Wow, okay. So they need the legacy business to stay strong enough to fund the bridge to the future business.
It is a very delicate balancing act.
So if you were tracking this digital infrastructure space, what are the key milestones you should look out for over the next roughly 3 months?
There are 3 primary events on the Catalyst calendar you really need to monitor.
Okay, let's hear them.
First, Cipher's own quarterly earnings. The market is well aware of the negative net margin, so they won't be overly distracted by that.
Because they know it's a build-out phase.
Right. What they are going to look for is hard evidence of pipeline conversion. They want to see signed memorandums of understanding with hyperscalers, proving the crypto capacity is actually converting into real AI revenue.
Show us the receipts that the rail yard is successfully switching the tracks.
Exactly. Second, pay close attention to the earnings reports of the hyperscalers themselves, the Microsofts, the Metas, the Amazons.
To see if they're still buying.
Yes. Any commentary from their leadership teams reiterating that they are still fundamentally constrained by physical power capacity will act as a direct macro tailwind for infrastructure providers like Cipher.
Got it. And the third?
Keep an eye on the progress of the Clarity Act. Like we said, any legislative clarity that supports the crypto market secures the funding bridge Cipher relies on.
All right, so we've covered the wild financial mechanics of non-cash depreciation, the incredibly deep moat of secured power access, the explosive price action driven by insider block buying, and the very real risks of a sky-high valuation dependent on flawless execution.
A lot to take in.
It really is.
Yeah.
So what does this all mean? What is the final consensus from our source stack?
The overarching consensus gives Cipher Digital an 8 out of 10 bullish score.
Okay, 8 out of 10. That's strong.
However, the target horizon here is crucial. This isn't viewed as a quick day trade or a short-term swing.
Right.
It is categorized as a multi-year hold, roughly 12 to 24 months.
Because it's going to take that long for the massive infrastructure investments to finalize and for those high gross margins to finally reflect in their GAAP earnings.
Right, GAAP being the generally accepted accounting principles that govern official profitability.
Yeah.
Once the depreciation schedules normalize and the take-or-pay contracts initiate, the true profitability of the AI hosting will finally reveal itself. Cipher is viewed as a premier public market proxy for the AI infrastructure build-out.
Yeah, that makes sense.
They offer asymmetric upside as AI demand continues to outstrip global compute supply, provided they can successfully walk that tightrope of execution we talked about.
It is an incredible story of a company attempting to adapt, like in real time, to the biggest technological shift of our generation.
It really is.
But it leaves me thinking about the bigger picture. It's, we are watching companies originally built to solve math puzzles for digital tokens successfully pivot their massive gigawatt-scale power grids to host artificial intelligence.
It's quite the evolution. And if this pivot proves sustainable across the industry, we might be witnessing the birth of an entirely new sector.
How so?
Well, as AI becomes integrated into every single facet of our daily lives, the underlying power demands are going to dwarf anything we've seen before. It raises a fascinating question for the future. Will the distinction between a tech company and a power utility company completely disappear?
Oh, wow. It makes you wonder if the most valuable tech companies of tomorrow won't be the ones writing the code, but the ones who own the plug on the wall.
Exactly. The rail yard operators controlling the flow of power.
The ones feeding the stomach. Well, that is where we will leave it for today. Thank you for joining us on this deep dive. We hope we've given you the ultimate shortcut to being well-informed on the shifting sands of digital infrastructure. Keep your eyes on the data, and we'll see you next time.